don't forget to hit that lovely like button, and don't forget the sexy subscribe button. A lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to £200 dollars, depending on the platform you use if you deposit a small amount. Hi guys, welcome to the SavvyMoneyShow with me, host Sean. Well, today we've got to talk about short squeezes. I'm not going to go with the usual companies, and I'm going to go with companies that are shorted but are good companies anyway. We start with the worst one, but how can the worst one be a good one? It gives a 3.5% dividend, P ratio of 21, and I call it a worst one because it had a decline in growth last quarter. But it still had good growth over the last year. Pets Med Express, ticker symbol PETS. Now, the thing about this is you will see it's a PEG ratio of 1.79, price to sales of 2. If you go to financials, you will see that its assets well outweigh the liabilities, and we will see that its free cash flow does as well. Now, if you go back and look at short ratio, short percentage of float is 39%, and this is a pet insurance company. Now, Simply Wall Street has it as fair value at $36, and it has hit $56 a few times because of the shorts. As soon as it starts running, the shorts are forced to cover. Now, when you look at the holders, institutional, the amount of institutions that hold it, 86% is held by institutions. That tells us that if the shorts have to cover, there's not going to be so much of the flow for the shorts to cover with. Now we go to the next one. Now I spoke about Pubmatic. I'm not going to speak about it again. The thing about Pubmatic is if all their bonds are and all their convertible loan notes are all converted, which if a short squeeze occurs, they will be, then there will be a massive amount of shares on the market. The other three that I'm talking about today, they won't have that. They will still have a low float. But Pubmatic, I spoke about it. I spoke about how it has potential, but the problem with that one, when looking further into it, it has a massive amount of bonds and convertible loan notes. The other ones haven't diluted it with them. And you see on track, ticker symbol OTRK. Now, doesn't pay a dividend, but we're not in it for the dividend. You see a price to sales of 6, and if you look at the short percentage of float is nearly 28%. Now, this is a company that's growing, and you can see here that it outweighs liabilities quite a lot. I think that even that it has 88% of its shares held by institutions again. Now, Optima Health selects On Track for all Medicare medical aid business because its software and plan is very good for medical health and medical insurance, and that's an area that seems to be surging this year. And we now go to Marine Max, ticker symbol HZO. Has a PE ratio of 8.6. We can see forward PE of 8, price to sales of 0.57, which most companies in retail are. Price to book of 2, which is not bad. It's pretty good actually. And it's been growing year over year. And you can see that the assets double liabilities. So I think even if there isn't a short squeeze, it's still a good company to own. These are still good companies to own long term. But I think people get too caught up in GameStop and AMC. I've even spoke about in my Discord, like, because I spoke about Vino a week or two ago, and now Vino's gone on a run. I spoke about MSN in my Discord, and my Discord's completely free for anyone. But you've got to think, right, Roaring Kitty and the people who owned GameStop, who was in Wall Street Bets with it from the start, they was in from last year when stocks were low, and they had all their funds in it. Now, yes, they've 20x their money, but remember, I don't think Roaring Kitty has pulled all his money from. I don't think he's pulled half of his money from GameStop, but if he'd have put it in a number of other stocks like Tesla and Neo and Bio Nano, or it could be, you could throw out a dart at that time, you could have ended up 20x in your money, not just on one stock but on a number of stocks. You would have ended up 20x in. They combined it. So putting it all on this one stock and hoping this one thing happens was a big gamble. I'm glad it paid off for him, but of course then he's ended up in front of a committee, a Senate committee, and all that stress. But he's also made a name for himself. The thing is, what would have happened if he didn't pay off? This is the thing. We also heard reports about people calling up afterwards saying they put their pension funds into it and they didn't pull it in time. They've put their life savings into it. That's why you want to look for a good company, a company which is solid. So even if it doesn't squeeze, you're protected. And if you're going into a short squeeze company, make sure once it multiplies, you pull your original investment out. Then you can do what you want. It can do what it wants. You're still in profit. Anyway, don't forget to hit the like button, comment in the box below, subscribe if you haven't already. I'll see you in the next video.